Okay, dear students, so today we are moving towards a new topic. The name of this topic is capital gain tax or chargeable gain tax. Okay, and this topic has its own weightage like a 10 mark minimum. MTQ comes in the exam, and a variable like MCQs also come in the exam. And this is a very separate area, I would say. Like if you grip on these areas, you can easily score good. This is Mustafa Mirchawala, your trainer. So without wasting a single minute, let's move to this topic. Now the first thing is, previously we were doing revenue receipts area. Like I hope you remember the income tax computation thing, non-saving interest dividends. They were revenue receipts. But now we have just dived into capital receipts world, right? Now we will be doing investments, like we are buying a property for $1 million. For example, we are buying a property for $1 million and later on we are selling it for $1.5 million. So this $0.5 million top is called capital gain or chargeable gain. Same is the case with gold. If you invest in gold and the prices went up and you sell it, so again, this is also a capital gain. Same in the case with stock market shares. You buy shares, let us say for $10, and later on you are going to sell it for $15. So the $5 top is called capital gain. Okay. So now we are moving towards the world of capital gain. Okay. Now, first of all, let's do it with very basic things. For example, few years back, 2 3 years back, we bought a chargeable asset. We bought a chargeable asset for 20,000, right? This is our cost. And after 2 years today, we sold it for 60. So 60,000 is your proceeds, or sometimes we call it disposal proceeds. Sometimes we call it disposal proceed. So 60,000 is your proceeds and your cost is 20,000. So your chargeable gain, the first step is chargeable gain is 40,000. Chargeable gain is 40,000. Okay. Now, listen very carefully. Now, each and every individual in UK, each and every individual in UK get one fixed amount of relief, which is called annual exemption. That means at the end of the fiscal year, let us say you have 3 4 or 5 gains, you will accumulate all gains, and one time you will deduct annual exemption from that. Okay. And that annual exemption is now 3,000. Exemption is now 3,000 fixed. You have to learn it in the examination, it will also be given. So annual exemption is 3,000. Now wait, this annual exemption is just like personal allowance. Hope you remember the world of revenue receipt, non-saving interest, dividend. Remember income tax? So in income tax, there was one thing which is called personal allowance, and here you have annual exemption. But yes, there is one difference. In the income tax area, personal allowance used to vary with ANI, right? Personal allowance was dependent on ANI, and sometimes you have seen when your ANI goes up, your personal allowance goes down. Remember the working? But here, this annual exemption is fixed. Here, this annual exemption is fixed. Okay. So annual exemption is 3,000. 40 minus 3 is 37. Now this 37,000 is your taxable gain. This 37,000 is your taxable gain. My dear student, taxable gain is the gain on which we directly apply tax rate. Taxable gain is the gain on which we directly apply tax rate. Now, what are the tax rate? Now, before moving on, let me show you different types of gains. So right now, there are only two types of gain. The first is, see the screen, RPG, residential property. RPG stands for residential property gain. Residential property gain, what does it means? Let us say you are buying a residential property and later on you are selling it, and if you have a gain, this is called residential property gain. Now listen, the property must be residential property, no matter you are living it inside it or not. It's not a big deal, but the property should be residential property, means it's in residential area. Okay. No matter if you are living it inside that property or not, it doesn't make any difference, still the property will be residential property. Okay. Now, so, and for residential property gain, the tax rate is, listen, see, 0 to 37,700, 0 to 37,700, it's 18%, and 37,700 and above, it's 24%. 37,700 and above is 24%. Okay, so there are two tax rate, 18 and 24% for RPG. And my dear student, right now in capital gain tax world, there are two bands only: 0 to 37,700 first band, and then 37,700 and above, it's second band. Okay, right? Then the other types of gains are called NG, that is normal gain. Just giving you example. For now, just keep this thing in mind. Whatever gains you have other than RPG, whatever gains you have other than RPG is normal gain. For example, stock market gains. If you have shares, you sold it later on and you got the gains, so that will be normal gain. Okay, now normal gain we call it NG. Normal gain we call it NG. For NG, the tax rate is 10 and 20%. For the first band, it's 10 and then 20%. So please open your eyes and listen very carefully. You have the first band tax rate for RPG 18 and 24. First band is 18, second band is 24. For NG, first band is 10 and the second band is 20%. Okay, now one question: if both RPG and NG exist of an individual, for example, in one fiscal year you have 2 3 gains, in one fiscal year you have 2 3 gains, like one is RPG, otherwise one is NG. So now, but you have only one annual exemption. Every fiscal year you have only one annual exemption available. Now how will you use annual exemption? On which priority? See the priority. Annual exemption will be first used against RPG and then NG. First use against RPG and then NG. Annual exemption will be first used against RPG and then NG. What is the logic? Because RPG has got the highest tax rate. RPG has got the highest tax rate. So if you reduce RPG, you will get more tax benefit. If you reduce your residential property gains, you will get more tax benefit. Okay, and we all need to minimize our tax. Now, one question as a student you may ask, sir, hope you remember we used to work like this. In the previous income tax, we were doing in non-saving, then interest, then dividend. Remember these famous three columns? Hope you remember the famous three column non-saving, interest, dividend. Now, as a student, you may ask, sir, can we make the fourth column? Can we make the fourth column of gains? No, no, that's not allowed. This is not a good presentation, because non-saving interest dividend were revenue receipts. Non-saving interest dividends were revenue receipt, and this gain is capital receipt. So it's better you do it on the other page, or skip few lines and then solve gains. Okay, so gains is a separate world, non-saving interest dividend is a separate world. One more difference I want to say: on non-saving interest and dividend, the tax which you were calculating was income tax. Remember the requirement: income tax liability. But here your requirement will be CGT. Here your requirement will be CGT, means chargeable gain tax. Now you need to calculate CGT. Previously you were calculating income tax. Okay, now one more thing. See, one more thing, as a student you may ask this thing: sir, listen, as a student you may ask this thing, that sir, there is a person who has lot of income, like he's doing business, so he has a trading income which is non-saving, doing job, has employment income, have interest income, dividend income, and different type of gains. So now what is the final income tax computation order? How we will be calculating tax? If we have all these incomes? So the simple rule is, listen, the simple rule is, first of all, always go for non-saving income. First calculate non-saving income, tax on non-saving income, then interest income, then dividend income, then normal gain NG, and then RPG. Non-saving, first of all, always calculate tax on non-saving, then interest income, then dividend income, then NG, and then RPG. Okay, and your bands will be utilized in such a way. So I would request, you will see this, that lot of times these three incomes these three incomes will utilize your first band 37,700. These three incomes normally utilize your first band. So when you reach to gains, normally your first band is already exhausted. Normally your first band is already exhausted. Normally your first band is already exhausted. Okay, now as a student you may ask, sir, why NG first and then RPG? Because NG's tax rate is low. NG's tax rate is low, so we'll have some tax savings. We'll have some tax savings. That's why. That's why. Okay, right? So let me recall you the last time the final tax computation order on non-saving first, then interest income, then dividend income, then NG, and then RPG. Okay. Now, my dear student, let's start with the first question. Let's start with the first question. I have my calculator in front of me. You have in the requirement they are asking, they have given you non-saving taxable income. Use your brain. Non-saving taxable income means personal allowance already deducted. Personal allowance already deducted from this. Okay, then you have RPG and NG. You have RPG and NG. Now you tell me, take your decision. Each and every individual gets annual exemption every year of 3,000. Now from which gain should I deduct? From which gain should I deduct annual exemption? Always RPG first. Always RPG first. Okay, so let me deduct annual exemption, which is 3,000. Okay, so 30 minus 3 is 27. 30 minus 3 is 27,000. 30 minus 3 is 27,000. Okay, so now finally we got the taxable gain. Now, my dear student, read the requirement. The requirement is CGT. They are not asking you. They are not asking you income tax. Okay. But still, as this is the first question, let me calculate a little bit income tax also. Okay. So now what is the tax computation order? First, we'll solve non-saving. First, we'll calculate tax on non-saving. Now you use your brain. Your non-saving income is 50,000. You came and knocked this first band. Knock this first band. So the first band tax rate, first band capacity is 37,700 and your non-saving income is 50,000. So definitely the complete first band will be consumed. Complete first band will be consumed by non-saving income. Let me don't write the final answer because my objective is not to calculate income tax. Right now, my objective is not to calculate income tax. My objective is not to calculate income tax. Okay, now you tell me, out of 50,000 we have calculated tax on 37,700. So how much is left? 50,000 minus 37,700 is 12,300. Now what is the tax rate for the second band? What's the tax rate of non-saving for second band is 40%. Okay, so just giving you a recall, previous recall. Right now they are not, the examiner has not asked you income tax, so no need to calculate it, leave it. Now the objective is your first band is totally consumed. Your first band is totally consumed. First band is totally consumed. First band is totally consumed. Now come for RPG and NG. Now let's calculate. Now let's calculate capital gain tax. Let's calculate chargeable gain tax. So what I told you, for chargeable gain tax, just follow one order. First calculate tax on NG. First calculate tax on NG. NG is how much? NG is 20,000. And as in this question, my dear student, use your brain. As in this question, your first band is already consumed. Your first band is already consumed. So obviously NG will come in the second band. And what is the second band tax rate? See the tax rate, it's 20% for NG. So 20,000 multiplied by 20%, which is I think 4,000. Okay. And now come to QG, RPG. Now come to RPG. The gains for RPG is 27,000. And obviously we are in the second band because the first band is already consumed. So the second band tax rate for RPG is 24%. Oh, sorry. Six four eight zero. 10480, 10480. 10480. Right, that's the end of the first question. Now we'll move on next question in such a way that sometime you will have some first basic rate band unused. Your non-saving income will be less in the next question, so your basic rate band will be unused. Okay, see. Now you have non-saving taxable income is 12,000. Non-saving taxable income is 12,000. Okay. So taxable income means personal allowance already deducted. Personal allowance already deducted. Personal allowance already deducted. Personal allowance already deducted. Okay. So my dear student, each and every individual gets annual exemption every year. Annual exemption every year of 3,000. Now you tell me there are two gains. From which gain should I deduct? Should I deduct annual exemption? Definitely RPG. So we'll deduct 3,000 from here. So 38 minus 3 is 35. This is your taxable gain. You came to the taxable gain finally. Now non-saving taxable income is 12,000. I'm not gonna calculate any tax on non-saving because my requirement is not income tax. My requirement is not income tax, it's CGT. But yes, I'll just use the band. So use your brain. Your first band is 37,700 and you will consume 12,000 for non-saving. So how much of your first band is left? 37,700 minus 12,000. It's 25,700. It's 25,700. It's 25,700. Okay. Now this unused capacity will be used for gains. Okay. Now my respected student, let's start for gain. And what I told you the order always calculate tax on non-saving income first, then interest, then dividend. There is no interest and dividend, so leave it. Now in gains, when you come to gains, always go for NG first and then RPG. First NG and then RPG. Now start, please. You will pick this 21,000, this 21,000, and you'll knock this band. You will knock this band. Okay. So luckily we have more capacity. Luckily we have more unused capacity in the first band. Okay. So NG will come. NG will come in the first band, that is 21,000 multiply by 10%. Multiply by 10%. We all know the first band tax rate for NG is 10%. The first band tax rate for NG is 10%. So it will be 2100. Okay. Now, out of 25,700, we have used 21,000 more. So 4,700 is the unused capacity. 4,700 is the unused capacity. 4,700 is the unused capacity. Okay. So now this unused capacity will be used in RPG. Okay. Now last RPG is left. So let's calculate tax on RPG. Your RPG is 35,000. You'll pick it up and you'll knock this band. You'll knock this band. So now how much is left? 4,700 is left. So we'll write RPG here. 4,700 will come in the first band of RPG and the first band tax rate is 18%. 846. Okay. So finally this band is totally and consumed. Now out of 35,000 you have calculated tax on 4,700 on RPG. So 35,000 minus 4,700 gives you 30,300. Now definitely first band is totally consumed. So this 30,300 will go in the next band of RPG and the tax rate is 24% for that. Tax rate is 34% for that. 10218. 10218 is your answer. 10218 is your answer. Please. Okay. Dear students, now next question. Now I would request you to pause the screen and do it yourself. Pause the screen and do it, then see my solution. Okay. So now your non-saving taxable income is 14,000. Definitely, this will consume your first band a little bit. Now RPG is 2,000. RPG is 2,000. Remember, I just told you the priority of using annual exemption is first always use RPG and then NG. Well, first RPG and then NG. So let's do it. Your annual exemption is 3,000. So out of 3,000 you'll use 2,000 here. This will be 0 now. Finished. And listen, still we have some annual exemption left, so we are not going to waste it. We are not going to waste it because we have other gains. So now we'll use here. Okay, so this is what we call priority means first go for RPG. If some annual exemption is left, then go for NG. So you have 29,000 of taxable gain with NG, and there is no RPG gain in this question. Okay, so now first of all, you will calculate tax on non-saving. So non-saving will consume your first band. Non-saving income will consume your first band. Non-saving income will consume your first band. Okay. Non-saving income will consume your first band. Non-saving income will consume your first band. Okay. Now, how much of your first band is left? 23,700 is left. And there is only one gain in this question, which is NG, which is NG. Okay. So simply calculate tax on NG. Very easy. You'll pick this 29,000 and you'll knock on this band. You will knock on this band. You will pick this 29,000 and you'll knock on this band. So my dear student, the capacity, unused capacity is 23,700. So complete unused capacity will used. And what is the first band? What is the first band tax rate for NG? It's 10%. So 2370, and now this band is done, finished. So out of 29,000 we have calculated tax on 23,700. So still how much is left? 5,300 is left. 5,300 will definitely go in the second band. So 5,300 multiplied by 20% is 1060. Okay. 3,430 is your final CGT liability. 3,430 is your final CGT liability. Okay, let me write one more question for you. Non-saving taxable income is 21,000. Okay. Then we have RPG of 28 and we have NG of 32,000. Okay. So please start. Please start. Let's do it. Obviously, we all know annual exemption is always first deducted from RPG. Okay. So we'll deduct annual exemption of 3,000 from here. So 28 minus 3 is 25,000. 28 minus 3,000 is 25,000, right? So your non-saving income will consume your first band, and this will be 37,700 minus 21,000. 16,700 is left. 16,700 is left. 16,700 is left in the first band. Okay. Now, how you will do it? Definitely for gains calculation, for CGT calculation, you will first start with NG. So you'll pick NG and you'll knock this first band. You will knock this first band. So yes, the capacity is less. So we'll consume all this capacity for NG. It's going to be 16,700 and the first band tax rate for NG is 10%. So 1670, right? Now, out of this band is totally done, consumed, finished. Now, out of this 32,000, we have calculated tax on 16,700. So it's going to be 15,300 is left. And definitely it will go in the second band of NG. Second band of NG. Okay. So 15,300 into 20% is 3060. Okay. Next thing is RPG. Next thing is RPG. So RPG is 25,000, and as we all know, the first band is totally consumed, totally consumed. So whatever RPG is there, it will straight away go in second band. And RPG's second band tax rate is 24%. RPG second band tax rate is 24%, which is 6,000. Okay, so one more question done. One more question done. One more question done. Now we are moving towards capital losses. We are moving towards capital losses. I hope you remember in past I taught you property income and I taught you the losses of property income. And at that time I told you a rule. Listen, that when you are in profits, that means the good times are going on, then tax department charges tax from us. In good times, tax department charges tax from us. And same is the case in the bad times. In the bad times, tax department gives us tax relief. Tax department gives us tax relief. Tax department gives us tax relief in times of losses. Okay, so it happens in all the incomes. It goes with all the income, like property income, capital gains, everywhere. That in good times, like in profit times and gains time, you have to pay tax. In bad times, government will give you relief. Okay, so now what is the relief? For the first relief, listen, for example, for example, we have, listen, we have in our fiscal year, see the fiscal year, in one fiscal year you have one capital loss and one capital gain. So now I would give it the name of capital loss for the year. Whenever you have a capital loss for the year, whenever you have capital loss for the year, then this capital loss will never see for capital loss for the year. Capital loss will set off for the year chargeable gains without your permission. Capital loss for the year will never ever take your permission. It will directly, without any permission, it will directly smash, it will directly offset your chargeable gains for the year without asking your permission, without asking your permission. Okay, so let's do one question. See, You have capital case number one. I have given it the name of case number one. You have capital loss for the year is 10,000. You have capital loss for the year is 10,000, and you have chargeable gains for the year is 12,000. So as this is for the year loss, so he want this loss will never ever take your permission, and it will set off your gains. So minus 10 plus 12 is plus 2. So your final gain is plus 2,000. Now see the bad, listen the bad news. In each and every fiscal year, individual has annual exemption of 3,000. Individual has annual exemption of how much? 3,000, right? But see, right now your gain is only 2,000. Your gain is only 2,000, so you can only deduct your annual exemption of 2,000, and yes, the remaining 1,000 annual exemption is wasted. Remaining 1,000 annual exemption is wasted. So always remember this fact. Always remember this fact. Always remember this fact that always remember this fact that listen, that annual exemption is a disposable thing. You have to use in the current year, otherwise it will be wasted. Okay, so now what is the disadvantage of this relief? I have written for the year capital loss will set off for the year chargeable gains without your permission. Without your permission means sometimes because of this your annual exemption may be wasted. Your annual exemption may be wasted. See the first case. See the first case. Your annual exemption of 1,000 is wasted. Your annual exemption of 1,000 is wasted. Okay. Now let's move to case number two. Let's move to case number two. Now in case number two, what is this scenario? In case number two, you have capital loss for the year 20,000 and capital gains for the year 15. So as it is the for the year capital loss, no permission. So minus 20 plus 15 is negative 5. Okay. So first step, listen. There are no final gains. There are no final gains, so you cannot calculate tax CGT. So definitely in this question, again your complete annual exemption is wasted. You cannot use annual exemption here. Okay, first thing. Second, out of 20,000 you lost, you have used 15,000 in front of this gain. So now what about the remaining? What about the remaining unused 5,000 capital loss? Yes, good news is this unused capital loss will be carried forward. This unused capital loss will be carried forward, and it will be used for future against future gains. See, capital loss to be carried forward against future gains. Okay, so listen very carefully. Capital loss can only set off gains. Capital loss cannot set off interest income, dividend income, and no other income, only gains. Okay, so any unused capital loss will be carried forward, and it will set off your future gains. Okay. Now from the next question. From the next question, I'll be giving you some brought forward capital loss. Just think, now you will have a question in which you will have some previous years brought forward capital loss with you. See this question, good question. Listen, you have my dear students, capital loss. First see this, capital loss for the year is 10, capital gains for the year is 30. Capital loss for the year is 10 and capital gains for the year is 30. So for first step, capital loss for the year never ever takes your permission. Capital loss for the year never ever takes your permission, so it will set off this gain. Minus 10 plus 30, minus 10 plus 30 is positive 20,000. Okay, now be active and use your brain. That means capital loss for the year there are no plannings. In capital loss for the year there are no plannings. There are no plannings at all. There are no plannings at all. There are no plannings at all. Okay, now but for the capital loss brought forward, now you have some capital loss brought forward of 20,000. There is a planning, and listen the word of law. Capital loss brought forward must be used in such a way. capital loss brought forward must be used in such a way that your annual exemption is not wasted. That your annual exemption is not wasted. Now, just think hypothetically. If I use this complete 20,000 here, I'm solving it wrong. I'm solving it wrong just for you. If I use complete brought forward loss of 20,000 here, then my final gain will be zero. Then my final gain will be zero, and I won't be able to use my annual exemption, and my annual exemption will be wasted. My annual exemption will be wasted. So that's wrong. In brought forward loss, you can do planning. Now use your brain. We should use capital loss brought forward to the extent that our annual exemption is not wasted. So I will deduct 17,000 capital loss brought forward from here. So I will get a final gain of 3,000. Now, as we all know, my annual exemption is 3,000. My annual exemption is 3,000. So this annual exemption will be deducted. This annual exemption will be deducted from here. So in this way, I have used my annual exemption. Now see the good news. See the good news. Your brought forward capital loss was 20. Your brought forward capital loss was 20,000. And out of 20,000, how much you have used? You have used 17. So still 3,000 will be carried forward next year. 3,000 of capital loss will be carried forward next year. Okay. 3,000 of capital loss will be carried forward next year for future use. And now this is what the brain is. Just think, if I would have used complete 20,000 capital loss brought forward in the current year, so I won't be able to carry forward anything, and my annual exemption would be wasted. So it's better to use annual exemption in this current period, and the brought forward loss which can go further carried forward. It's better to carry forward that. Okay, that's the best utilization, because annual exemption is a disposable product. Annual exemption is a disposable product. If you are not going to use it now, it will be expired. Okay, I sometimes say this to my student, that let us say we are going for a picnic or a tour with lot of food with us, and there are some food which are going to expire today or tomorrow, just in one day, and there are some food which are going to expire after 5 days. So definitely we'll eat that food first whose expiry is near. Whose expiry is near. This is common sense. Okay, so let me give you the last summary, final summary, so that we can move to the next case. See, in current year capital loss for the year, there are no plannings. For capital loss for the year, there are no planning. It can waste your annual exemption. But yes, for brought forward capital loss, there is a planning. For brought forward capital loss, there is a plan. Now, very good question. See, in this question, you have capital loss brought forward. Case 4, see the case 4. Capital loss brought forward is 15,000. Now, for the year capital loss is 10, and for the year capital gain is 12. So first step, for the year capital loss never ever takes your permission. So minus 10 plus 12, the final answer is 2000. Now I want to check your intelligence. I want to check your intelligence. Listen. Do you think we should use our precious capital loss brought forward here? No, because the final answer is 2000, which is less than 3, which is already less than 3. So annual exemption can kill this gain anytime. Annual exemption can kill this gain anytime. So why to use the precious loss? Why to use the precious capital loss brought forward? So capital loss brought forward will come, will this loss we have saved, and it will go as it is in future for future usage. It will go as it is in future for future usage. I sometimes tell one joke for this area. Just think, we have one enemy which is already on the deathbed and on the last moments. So now no need to use the precious bullets. No need to use the precious bullets on that enemy, because that enemy is going to die in few seconds already. So no need to use your capital loss brought forward, which is very precious, when annual exemption can do this job. When annual exemption can do this job. Okay, now case number five. Case number five. Listen, capital loss brought forward is 15,000. Brought forward capital loss is 15,000. Again, for the year, see the for the year capital loss is 10 and for the year gains is 5,000. I always say this thing, I've told this thing 4 times today, that capital loss for the year never ever takes your permission. So minus 10 plus 5, in the first step you get a loss. In the first step you'll get a loss. Okay, so when in the first step you have a loss, that means there is no gain, that there is no gain. And when there is no gain, so you cannot use your annual exemption. So yes, your annual exemption is wasted in this question. Now, this is 5,000 for the year unused loss plus your previous loss, the previous loss of 15,000. They both will join hands, they both will join hands, and they both will go carried forward. See, minus 5 minus 15 is minus 20. So this capital loss to be carried forward for next fiscal year is negative 20,000. Negative 20,000, negative 20,000. Okay. Okay, now one last thing I which I should discuss and you should ask this question. Listen, I just taught you this losses topic in a general way without using the word RPG and NG. I just used the word gains, gains. So as a student, you may ask this question, sir, if we have two gains in a question, RPG and NG, RPG and NG, and now the losses are coming. So how to utilize loss? How to utilize loss means in which order? Which order? So always listen, always kill RPG first. Always kill RPG first and then go for NG. Then go for NG. Always use your loss, always use your capital loss against RPG first and then NG. Why? Because RPG has got the high tax rate. See, RPG's tax rate is high and NG tax rate is low. So it's better to kill those gains which has high tax rate. So in this way, we'll get more tax benefit. In this way, we get more tax benefit. And listen, I repeat, I told you the same thing for annual exemption. If ever you want to use annual exemption, always use annual exemption for RPG first and then NG. For RPG first and then NG. Okay, right? So it's not difficult, general thing. You can do it. Okay, now one question which you didn't ask and I didn't tell. You know, RPG has got high tax rate. RPG has got high tax rate than compared to other gains. What I call normal gain. Why? Because government does not want a common investor to invest more in residential properties, because if everybody will invest in residential properties, the prices of residential property will go up, and then a common man will not be able to buy a residential house for his own use. So it will be a problem in the society. Okay, so that's why the tax rate for RPG is high. This is one of the logic. Okay, normally logic is not in part of your course, but it's my teaching style. I try to give some logics. Okay, now so one thing, on RPG they have increased the tax rate. Now the second punishment with RPG, listen very carefully, that right now I have not told you the due date when you have to pay the CGT. When you have to pay the CGT, normally it's after the end of the fiscal year, many months after the end of the fiscal year. Like for 24-25, your 24-25 fiscal year ends on 6th April, 5th April 2025, and you have to pay CGT after many months. I'm not telling you date right now, okay? So for normal CGT you have a lot of time, but they have now in recent few years back they have changed the law that with rpg residential property gain, you need to pay the first installment, the advance tax, which is called payment on account, within 60 days. See, within 60 days of the gain, within 60 days of the gain. So this is one more punishment, this is one more punishment and a new topic, okay? Right? So with rpg, whenever you see in question rpg, so you need to pay payment on account, you need to pay payment on account within 60 days of the rpg, right? This is called what? First installment or advance tax. So the shortcut for payment on account is POA. The shortcut name for payment on account is POA. For POA, just read the law, just read the law, I'll teach you practically everything. For POA, you need to account for capital losses brought forward and for the year capital loss till the date of gain, okay? So we have read the first line. For POA, the first installment calculation, you need to account for all capital losses brought forward and for the year capital loss till the date of gain rpg. Now as a student you may find it little just boring, or just we are reading it. Okay, wait, let me show you the real question and then you will understand in seconds. Okay, so this is the first question, this is the first question we are doing, and this came in the article as well, this came in the article as well. See, Zake, the name of the boy is, the guy is Zake, a HRTP. HRTP stands for higher rate taxpayer. Now, what is the objective of using the word higher rate taxpayer? Is this higher rate taxpayer means the first band is already consumed, so this guy is already on the second band. This guy is already on the second higher band. Has the following gains and losses during 24-25. Now use your brain. On 10th April 24, see, the dates are already aligned, the dates are already aligned. See, on 10th April 24, first there is a capital loss from disposal of shares, so it's a loss. Then 31st May 24, a chargeable gain of 28,200 from disposal of shares, so it's NG, it's not RPG, okay? Then 31st August 2024, a chargeable gain of 82,000 from the disposal of RPG. Now this is the area. So as I I just recognize RPG. I just recognize RPG. So I have made a rectangle. See, I have made a rectangle, a border in front of RPG, in front of RPG. Can you see this? Now, why I have made this border? Now, for the calculation of POA, the payment on account, you just need to account for all these losses, all these previous losses till this date of RPG, till this date of RPG, all losses, all capital losses brought forward or for the losses till the date of RPG. Okay, right? That means this loss, this is the future loss, this is the future loss. See, March 25, so it came later on. So right now we are not going to involve it. Okay, so my dear student, if you want to see the sketch, your fiscal year starts on 6th April 24 and ends on 5th April 25. 6th April 24 to 5th April 25. Now on the timeline, see the screen, I have plotted all these events. So this August 24, August 24 is the event of RPG. So we need to account for all previous losses in the calculation of RPG, in the calculation of payment on account. Okay, so let's do it. Just for your easiness, I would like to say, if you want to take the picture of this question, you may take, so because I'm going to move the screen now. Okay, now just see what is your, see the heading, calculation of POA for RPG August 24. Okay, tell me the amount of RPG gain. It's to 82,000. Now any losses before this event? Yes, there is a loss of 4,600. You can see there is a loss of 4,600 in the main question, it's here. Okay, and we have already studied just the losses topic, that it's ideal to set off your capital loss in front of RPG. It's ideal, and it is the order of tax department. This is the order. So 4600 4600 is your capital loss. Then every fiscal year individual gets annual exemption, and yes, for annual exemption the first priority is RPG. So 3000 is the annual exemption. So 82,000 minus 4600 minus 3000. Okay, this is your taxable gain, and this taxable gain is RPG. And now use your brain, as this guy is higher rate taxpayer, so that means the first band is already consumed, so it will come in the second band, and the second band tax rate for RPG is 24%. So it's 17856. 17856 is your payment on account. 17856 is your payment on account. Okay, now I'm giving you a $1,000,000 advice. It will save you or you from all confusions. Once you have calculated POA, just forget about this working. Now ignore, just forget about this working, all these. Just ignore. Only just remember this POA. Only remember this POA, that's it. Forget about this working. This is a $1,000,000 advice. You will later on, you will thank me. Okay. Now just forget about this POA working, and just keep this POA, this advanced tax, within 60 days. Within 60 days of the gain you have to pay. Okay. Now what will happen at the year end? At the year end, you need to calculate all taxes from zero, all CGT from zero. At the year end, you need to calculate all CGT right from zero, as if you have not done any calculation in the past. Okay, year end self-assessment final tax calculation. So now see the full question. See the full question now. Complete question. All dates, and what I'm saying, just forget about that POA working. Just forget about, right? Just think you are doing tax calculation right from the scratch, from zero. You are doing first time. Simple. Okay. Now let's pick the gain. In the question, there is one gain which is called RPG. See, this is 82,000 RPG, and there is one gain NG. Okay. So we'll make the two column RPG and NG. RPG is 82,000, NG is 28,200. Now, do you have losses? Yes, you have losses. Where to use the loss? Always use loss in front of RPG. Always use loss in front of RPG, because RPG has got the high tax rate. So how many losses are there? See, there is one loss of 14,000 during the fiscal year, and one is for, now we have two losses. See the big picture. See the big picture for the whole year. So 4,600 and 14,000. 4,600 and 14,000. These are the two losses. And yes, then you will have annual exemption. Every year you get annual exemption of 3,000. So annual exemption is also deducted from RPG. Now as a student, something is coming in your mind. I know, sir, you used annual exemption in the previous calculation. Forget it. I told you, forget it. Just ignore it. If you keep thinking about that thing, you will get confused. Just think you are doing it for the first time. That's the best advice for you. So 82,000 minus 4,600 minus 14,000 minus 3,000. 60,400. Okay, your RPG is 60,400. Your RPG is 60,400. Okay, now let's calculate gain. Whenever we calculate gain, first we do for NG. NG is 28,200. As we all know, in this question there is no first band left, because this guy is higher rate taxpayer, so everything will go in the second band, and the second band tax rate for NG is 20%. So 28,200 into 20%, 5640. Now how much is the RPG? RPG is 60,400. And what is the tax rate for RPG in the second band? It's 24%. Thank you. So 60,400 multiplied by 14496. Okay, plus, so 20136 is your total actual CGT for this year. Total actual CGT for this year. Now, hope you remember your past classes. This is your actual CGT bill. This is your actual CGT bill. Okay. Now you will tell government, okay, I'm ready to pay this. But from this 20136, I have already paid some amount in advance. I have already paid some amount in advance, that is POA. That is POA. I have already paid some amount in advance. Remember? So tax department will say, okay, out of 20136, you have already paid how much? 17856. So that 17856 will be deducted. And yes, remaining amount you can pay. That will be final CGT payable. Okay. And now, if this bad thing coming in your mind that you have used annual exemption 2 times or losses 2 times, no, just give your mind a relaxation in this way, that your actual tax was 20136, your actual tax was 20136 was your actual tax, and believe me, you paid this. How? 17856 in advance and then 2280. So if you add these two, 2280 plus 17856, that means you have paid 20136, and which is the perfect tax. Okay, so this was your first question which I have just taught you. So whenever you find RPG, now make your summaries. See, summaries are very, very important. You need to make your summaries in F6 paper. F6 paper is about small things. So after attending lecture, always make your summaries so that it help you in future. Okay. So my dear student, what I did, see this, see the rule. For POA, you need to account for capital losses. For POA, you need to account for capital losses brought forward. See, in this first question, I didn't give you any brought forward capital loss, but in the next question, you will be seeing the capital loss brought forward. And for the year capital loss till the date of gain, remember I made a rectangle. And then what, this RPG will also be included in the end of the year self-assessment CGT calculation. Yes, it means at the year end, solve question right from the zero. At the year end, solve question right from the zero, solve question right from the zero, right from the scratch. Okay. So let's do one more question. See, this is one more question. Now, first of all, at the beginning, I have written HRTP. That means the guy is higher rate taxpayer. Now you have capital losses brought forward this. Then you have NG normal gain. Then you have capital loss, and then you have RPG. See, this is the point. So we have made the rectangle. Okay. Now, for the calculation of first payment, which we call payment on account, first payment is called payment on account. For the calculation of first payment, which is payment on account, for payment on account, you need to calculate, for payment on account, you need to calculate, you need to account for all previous losses brought forward and till this date, all losses. Okay. So this is one brought forward loss and this is for the year loss. Both will be used. Okay. This is the sketch. If you want to do the timeline, see, this is the timeline we have used in September 24. Till September 24, all losses should be used. You can see. So calculation of POA, RPG September 24. Okay. Now RPG is 60,000. Brought forward capital loss, my dear student, was 10,000. And for the year capital loss till this date was 6,000. Now, every individual gets annual exemption every year of 3,000, and annual exemption is always deducted from RPG. So 60 minus 10 minus 6 minus 3. It's 41,000. Now, as this is taxable gain and this guy is higher rate taxpayer, so that means the first band is already consumed. So the second band, the higher rate tax rate for RPG is 24%. 9840. 9840 is your POA. 9840 is your POA. 9840 is your POA. 9840 is your POA. Now, what we'll do in the year end? Now, my advice. Remember my words. Just forget about this POA. For this POA working, just forget it. Don't think over it. Now, at the year end, solve this question right from the scratch. Right from the scratch for the whole year, for the complete tax. Okay. So, how many gains you have? Let's finalize the gain. You have two NGs. This is NG and this is also NG. 35 and 5 and one RPG. You have two NGs and one RPGs, and yes, you have one brought forward capital loss and two for the year loss. Two for the year capital loss as well. Two for the year capital loss as well. Two for the year capital loss as well you have. Okay. So let's do it. Final 60,000 is your RPG and normal gain is like 15 or 35 plus 5. Sorry. No, it's 35 plus 5. Yes. Okay. 35,000 plus 5,000. So it's going to be 40,000 is total NG. Now, what losses you have? You have losses brought forward. Now we are doing right from the scratch. Just think you are doing, you are solving this question first time. Give this message to you. So brought forward capital loss, yes, is always deducted from RPG. For the year capital loss, the first loss was 6,000 and the second for the year capital loss was 11,000. Now each and every fiscal year individual gets annual exemption, and yes, annual exemption is 3,000, and yes, annual exemption is deducted from RPG, the first priority. So it's going to be 30,000. Okay, now let's do it. For the tax calculation, first we'll go for NG and then RPG. Okay, NG is 40,000, and as the first band of this question is already consumed, so second band tax rate for NG, second band tax rate for NG is 20%. It's going to be 20%. So 40,000 multiplied by 20% is 8,000. Okay, and then the second band RPG is 30,000 multiplied by 24%. You know the higher rate for RPG. 7,200. 15,200. Now go very simple. Just give message to your mind that your actual total tax for CGT this fiscal year is 15,200. Your actual total tax for CGT this fiscal year is 15,200. But yes, out of this 15,200 you have paid some advance tax, you made that tax guy remember that, see, I have paid something in past. He said, okay, okay sir, please deduct it. So out of 15,200 we have already paid 9840. So 15,200 minus 9840 is 5360. 5360. Okay. I hope you guys have done this correct. Not difficult. Just make a plan. Just make notes properly. It's easy. Work with discipline. Let me show you the question again. So next topic, and the last topic of today's class is part disposal. Very interesting and very practical topic. Listen, let us say you bought a big plot of 5,000 yards or such, big plot, okay? But now when you plan to sell it, it's very difficult to sell such a big plot, so you decided to make pieces and you have started selling in pieces. So this is what we call part disposal. Means you bought a complete asset, but now you are selling just a part of it, selling a part of it, okay? So tax department says, yes, this part disposal event is also chargeable. This part disposal event is also chargeable and you need to pay tax on this as well, okay? So let's plan the question. Let us say you bought this complete CK. Can you see this rectangle, this complete rectangle? You bought it for £100,000. Okay. Now, out of this 100, you bought complete rectangle for 100, complete piece of land for £100,000. Now you sold this part, disposed of this part only. Okay. And your DP, the disposal proceed is 60,000. Disposal proceed for this part is 60,000. Okay. Now, tax department says, yes, pay tax on this, pay tax and calculate gain on this. We said, okay, this part has been disposed of. This part, okay, this part is disposed of. Let me highlight. So how to calculate gain? We'll simply write DP. We'll simply write DP, which is 60,000. Now the problem is the cost is given for the whole complete house. The cost is given for the complete plot. So we need, what we have to do, we need to apportion these costs between these two areas. We need to apportion this total cost between these two areas. And for apportionment we always use a base. We always need a base. We always need a base. And the base here will be used is the market values will be used as a base. Okay. So as this portion, this yellow highlighted portion is just sold in the market, so this disposal proceed is already the market value. This disposal proceed is already a market value for this portion. And for the remaining area, examiner will always give you, the market value. So market value of the remainder in this question is, let us say, 180,000. Market value of the remainder is 180,000. Now, dear student, please check how you will evaluate it. You need to calculate the weightage. You need to calculate of the weightage of this disposed of area. So the disposal proceed is 60. The disposal proceed is 60 divided by, check the market value for the whole rectangle. The market value is 60 plus 180. Now do multiply by 100. So you will see 25%. That means this portion has a weightage of 25%. This portion, the disposed of portion, has a weightage of 25% if you calculate through market value. If you calculate it through market values, okay, right? So how you will do it? The total cost is 100,000. You will do, see, 100,000 multiply by how much percentage? 25% will be given to this area. So 100,000 multiplied by 25% is 25,000. Can you calculate gain? 60 minus 25 is 35. See, this is the chargeable gain. So what is the topic? The topic is you bought complete property, complete asset, and now you sold a piece of it. So yes, selling a piece is also a chargeable event and you need to calculate gain for that piece. So this piece we have sold, this piece we have sold, this piece we have sold. Can you see? And we have calculated the gain. And how did we apportion the cost? We apportion the cost using the base of market value at the rate of disposal. Now, this is the formula. Those who want to do with the formula, allowable cost is equal to original cost multiply by, see, I use the formula in terms of percentage. See here, I use this formula here in terms of percentage. The formula is original cost into dp upon dp plus market value of the remainder plus market value of the remainder. Okay, now few things I need to teach you, and then I'll be teaching you the last question of today's session. See this. Let us say this is your plot and this area is sold, this area is sold, this is unsold. Okay, now look at the screen. If cost is related to complete property, if there is any cost which is related to complete property, then you always apportion, then you need to always apportion between the two portion. If the cost is related to the complete piece of land, then that should be split between these two using the apportionment which we just did. And what is the example of this cost? Initial purchase price. Yes, you bought the complete piece of land together, so initial purchase cost is for the whole house. Initial purchase cost is for the whole house. Okay, now second case, if cost related to the portion sold, if there is any cost which is related solely, which is related only for this portion sold, then deduct complete that cost from the gain calculation. Why? Because we have sold this portion and the cost is related to this portion only, then deduct complete cost. Now no need to apportionment. And the example of that cost is the commission or the legal cost, all the legal cost of sale. See, legal cost of sale only related to the portion sold. If in the question it is given legal cost to sell the asset, then that cost will be completely deducted from the gain calculation of that portion. Why? Because that portion is sold and that cost is exclusively for that portion. Now the last point, if cost is related to the portion retained, see, this is unsold portion. If there is a cost which is purely linked to this part only, this part, this part, unsold part, which is remainder, now no need to deduct that cost at all. Now no need to deduct that cost at all. Why? Because that portion is not sold. Now what is the example? Construction of garden in that portion. For example, we bought the complete plot and we constructed a garden in this area only, see the remaining area. So now that remaining area is not sold and that cost is only incurred on that area. So just ignore that cost for this question. Okay. So I repeat, read these 3 lines. 3 lines is very important. These 3 lines are the basic rules. If, see, the first one, if cost is related, any cost is related for the complete house, then that cost must be apportioned like we did. Number 2, if the cost is linked to the portion sold only, the portion sold exclusively incurred for the portion sold only, then deduct complete. Then deduct that cost complete in the gain calculation. And the third point is, if a cost is related to the portion retained, not sold, then no need to deduct that cost at all. See, now one new question for you guys, and you have to try it yourself. See, first of all, we bought a property for 80,000. We bought a property, cost of property means it's for the whole rectangle. Okay, and then later on, legal cost to sell incurred is 3,000, and this is the portion sold. The DP is given, the disposal proceed is given, and yes, the market value of the remainder is also given. Now just try your luck and solve it yourself. 99% of the students do it correctly, so you also try your luck. I'm teaching you, or I would say pause your screen, try it yourself and then see my solution. Okay, let's start. First of all, we need to calculate gain for this portion. See, this portion is sold. So how much is the disposal proceed? It's 100,000, so I have written 100,000. Now let's start deducting the cost. So the first cost is the cost 1, this cost, legal cost to sell. Legal cost to sell is exclusively incurred for the portion sold only. Sold, the portion which is sold. So this cost will be completely deducted from here without any apportionment. because legal cost to sell is incurred for this disposed of portion only. It is incurred for this disposed of portion only. Okay. Now, what is the next thing? This cost of property is for the whole property. Cost of property is for the whole property. So this cost of property will be apportioned between these two areas. Will be apportioned between these two areas. Let me do it with the, now let me try the formula. So 80,000 is the cost of property, multiply by DP is how much? DP is 100,000, divide by 100,000 DP, plus market value of the remainder is how much? 200,000. Market value of the remainder is 200,000. Can you do it? It's going to be 80,000 multiplied by 33.3%. 80,000 into 1 upon 3. 2. This is the final gain. This is the final chargeable gain. Okay. So I hope you did it correct. Make your notes, make your short summaries. Okay. Must after each and every class, make your short summaries because this whole topic is about recalling and recapping. Okay. Thank you. Have a nice day. Thank you.